All right. So now I would like to take the opportunity to introduce the speaker of the day, our esteemed guest, Mr. Harshu Ghate, who is the Managing Director for ESOP Direct and brings over 30 years of work experience in corporate finance, accounting, and financial management. He commenced his career as a partner with Kirtane and Pandit Chartered Accountants and co-founded ESOP Direct in 1998. He is very active in the policy-making initiatives on the ESOPs in India, as he is a fellow member of the Institute of Chartered Accountants of India and a licentiate member of the Institute of Company Secretaries of India. He has also conceived and developed ESOP administration methodologies and software solutions for the first time in India. He devotes his time to critical assignments on ESOP consulting, management, and statutory compliance issues, and strongly believes in sticking to core competency, specializing in a niche area, and striving to be a leading player in whatever area we work in. Thank you, Harshu, for joining, and over to you from here.
Sure. Thank you, Latika. I hope I'm audible.
Yes, very much.
Okay. Let me just share the screen. Is the screen visible?
Yes, the screen is visible, but we see only a Dropbox folder.
You're not able to see the screen?
Yes, we can see the screen. Do you want to open up the presentation that you want to bring up on the screen?
Yeah, I've opened the presentation actually. 1 minute.
Maybe you want to start the sharing again once. Yes, now we have it.
Yeah, okay. So good afternoon to everyone. It's a pleasure to be on this forum, and I thank the team at CXO Genie to give us this opportunity to present on this topic. What I understand from the profile of the participants in this webinar is most of us are from the unlisted space, and I'm presuming that all of us have some background on ESOPs, and many of us may have also implemented ESOPs. So I'm not going to go into the basics of what they are and how they work, and what are the legalities around it. I'll predominantly assume that all of that is sort of understood and we are all aware about it. What I'm going to do is spend a few minutes on the key trends and practices that we see, especially in unlisted companies. So those of you who are from the listed space, maybe we can have a separate chat, though some of these parameters what we see may slightly change for listed companies. And then we will get into the main topic of what are the top 5 challenges that we see companies facing, and we'll have last 10-15 minutes as our Q&A. So some of the key trends, first obviously thing is those of us who have not implemented, many companies want to know whether ESOPs really work. And what we have seen is in the unlisted space, more than 70% of the companies have said that they have worked, and remaining 28% have said that they partly worked. So there were some situations where it did not work. So maybe it has not achieved all the objectives. So the chart below that we have analyzed as to why some of these companies could not achieve the full success. And as you can see from that pie chart below, maybe ESOPs did not help in retaining people. So employee separations was one part which they could not sort of address because of ESOPs. The next bigger one was the plan itself was unattractive. So it could be that company did not grow well, or the valuation did not go up, or they they offered at a higher price, or whatever. So those were the top two reasons why in some cases ESOPs have not worked. Uh, Coming to the right hand side, in terms of the coverage trends, so as you can see, more than half of the companies are covering up to 10% of the employees. Though we also see that the next best number is companies have also covered more than 51% of the employees, some 14% of the companies. So this is a good sort of a thumb rule, one can say, and this can address the question of whether we should give it to all or not. The trend is that the top 10% of the company normally gets it. Obviously, there could be exceptions and some situations where you may want to increase the coverage, but that's more of a exception. In terms of the frequency of the grant, I think the most common one is the annual grant. So normally it coincides with your appraisals or your increment cycle. We also see a trend now where companies, I think, given the current crunch for talent, etc., companies have been granting on joining itself. So pretty much something which is given on day one without waiting for the candidate to really spend some time with the company. The next trends that we see is in terms of what is the kind of benefit the companies are hoping that the employees would make. So that determines how much to grant to people. So if you look at the left-hand top chart, where we are showing that employees who are highly critical, typically the ESOP benefit that is proposed by the companies or the grant is based on the assumption that employees would make more than 100% of the annualized CTC. So 83% of the companies grant enough options to employees who are highly critical, which should give them more than 100% of the annualized CTC benefit. And as you can see, as the criticality goes down, the trend is that the benefit that comes out of ESOPs also goes down. So for a low criticality profile of employees, the benefit mostly is between 25 to 50%. Looking at the top level, senior management people or highly critical people, at a CEO level, as you can see, the percentage is more than 67% of the companies are granting enough options which will give more than 100% of the CTC. Whereas if you go one level down, CXO and head of department or SBU head or whatever nomenclature we may have, the ratio goes down, and 33% of the companies are granting more than 100% of the CTC. That's again one good indicator in terms of the quantum of benefit one can look at. All these charts and data that we see is based on our own survey that we did in 2020, covering about 70 unlisted companies. In terms of vesting schedule, this is again a very common question as to what should be the way in which options should vest. I mean, should they vest equated or back-ended, front-ended? So here we can see the clear trend is that close to 2/3 of the companies are having equated vesting over a period. And in terms of the vesting conditions, the more popular one is a time-based vesting. So very few companies in the unlisted space have a performance-based vesting. 24% have a pure performance-based vesting. Most of the companies, more than half of the companies, have time-based vesting. There are also about 22% companies who have both a mix of time and performance-based. So this again would be a good data point to have. The next one we have is on the exercise term. So this is a very common question for unlisted companies because you don't have liquid shares. So should you allow employees to exercise or should you not allow, etc. So here we see that a more popular term is that companies are linking the exercise to liquidity. So even though the options would have vested, companies are saying that they can be exercised only when there is a liquidity event. The liquidity event could either be a change in control, or it could be a investment by a strategic partner, or it could be an IPO, or it could just be a liquidity event which the company has announced. So, but in the absence of such events, employees typically are not allowed to exercise, and there could be some valid reasons. We'll come to that, because this we see as one of the challenges going forward. Um, then coming to the liquidity terms as to how are companies providing this liquidity. So in the plan, the structure is 29% of them say that IPO is the liquidity event. 38% have a tag along clause. So whenever there is a corporate action or a strategic buyout, acquisition, etc., employees have a right to tag along with the promoters. 16% provide for cash settlement. So in case liquidity cannot be provided, they provide for some way of settling cash settlement, and 16% also allow buyback of shares. So that's a way companies have been defining as to how options would get liquidity. A challenge of how options with separated employees should be handled, again, is one of the top 5 challenges that we have. And the trend that we see here is, for if the company has allowed exercise and if the separating employee already holds shares, then most of the companies have been allowing the employees to leave with shares. So they are not providing, or they are not insisting on a buyback, either by promoters or by the company. So employees are allowed to walk away with the shares that they hold. A very small percentage are insisting on a buyback or by the purchase by the promoters, which has some challenges, and we'll talk about it. But this is what companies are doing. In terms of vested options, which are not exercised and they are in the state of options, and if the employee is leaving, then the companies are, there are more companies who are saying that you cannot walk away with vested options, and we will either buy back or they'll be cash settled by the company. So this response in a way is a bit puzzling, because for a company it should not matter whether it's shares or options. If you're allowing somebody to walk away with shares or options, I mean, it should be same for both. But this is what companies have been differentiating. The last slide on the trends that I have is in terms of the communication, and this again is we have identified as one of the challenges. In what way or at what frequency are we communicating with employees? So the overwhelming majority, like 2/3 of the companies, are doing this communication only at the time of grant. Not many companies are doing ongoing communications, say based on quarterly results or any other major corporate event, or anything which is even linked to vesting, for example. So this is something which is a challenge, and which we'll address again in detail. But this is a very important data point from making ESOPs work. In terms of the grant acceptance practices, so we have seen a lot of confusion and a lot of lack of uniformity in the way companies have been giving grants. So as you can see here, 43% of the companies are insisting on a acceptance of the grant by employees, because end of the day, if you look at it legally, a grant is an offer by the company to the employee, and technically, legally, unless that offer is accepted, it is not a valid offer. But there are companies who are saying that we don't need specific acceptance. I mean, just an issue of letter or a grant letter is taken as acceptance. And there are some companies who also feel that unless you reject it, we take it as a accepted. This again is it has both legal as well as user experience kind of implication. So this again is a good data point. We also ask companies as to what are the pain points they have when after the rollout happens. What is it that they struggle with when they are doing the day-to-day administration of the plans? So a lot of reasons have come out, no major sort of pain point. But I think the bigger one, if you look at top 2 or 3 ones, one is the employee communication, the awareness about the options or the processes among the employees. So how, I mean, once the grant is given, what else is expected from employees? What are his rights and what are his obligations and what are the limitations of those rights, etc. There is generally a lack of awareness. Companies are also struggling with the data accuracy. So typically, unless, I mean, there are now various platforms available to manage this data, but companies who are managing it on Excel sheets, etc., find data accuracy as a concern. Even though some of these platforms which are available, they are on the SaaS platform, so it is up to the company employees to sort of manage it and run it. And if there is a churn or a lack of discipline there, even a software may not help in case of a SaaS platform. So that is the next big concern. The other concern is about the tax calculations. Companies are not clear as to what are the tax obligations of the employees, when they have to pay, what is the obligation of the company, what rate the taxes should be calculated, how should valuation be done, etc. So that's another big challenge that so these are the top 3, I would say, the challenges, and we'll address some of these as we go along. Coming to the challenges, what we see based on our practice and experience over the last 10-15 years is that one big challenge is, of course, deciding which instrument to give, and we'll talk in detail about it. The second piece is on the documentation, and this is, as I said, one dimension of this is on the legality or the how the company should protect itself in terms of proper documentation, etc. But also what is shared with the employees and how complete that communication is. So that's the second challenge. The third challenge we see is this whole issue around what is the value of ESOPs and how is that communicated to employees. So and there are different versions. I mean, unfortunately, even companies have not been very consistent in terms of communicating what do they mean by value, and many times even employees understand it differently and they interpret it differently. So this is again a big area. We'll talk in detail about it. In the unlisted space, how should the exercise process be managed is also a big, I mean, there are various practices, and what we also see is with the availability of private equity funds and other strategic investors, etc., the time to IPO of companies has increased over the last 2-3 years. So earlier, if the company was expected to have some liquidity event, either IPO or some acquisition, etc., in say 5-6 years of time, now companies can do without going IPO for 10-15 years because they get the funding fairly easily and on the terms that they want, without incurring all the expense of getting listed and also the related hassles of compliance, etc. So so one challenge that companies are facing is by prolonging the time to liquidity actually is putting employees, making them restless in terms of how do they encash. So companies are not exactly aware as to how to deal with employees who are wanting to exercise and who are wanting some liquidity. So we'll talk about it. And finally, the challenge that we see is, though I think overwhelming companies have been talking about, they have said that they have achieved their objectives. I think it will be good to know, and companies do struggle with this, as to how we make sure that our plans work, and what are the challenges around it. So I'll go one by one in this. So in terms of the instrument structure, uh, so some of the topics here are whether one should go for a cash settled instrument or equity settled instrument. So the distinction being in a cash settled instrument, or what is also called as a phantom stock or a shadow stock. Um, you are not creating any equity, but you settle those options or the benefit by way of cash. So there is no question of issuing equity, or there is no dilution, etc. And the other way to do it is equity settled, which is like a normal vanilla stock options, where options get converted into equity, and then the employee owns that equity and he can then sell it at a premium. So that is one big issue which companies face, and this is something which has to be deliberated at a board level, at a founder level, and also at the investor level. The key issue there is whether there is a willingness to dilute. If there is no willingness to dilute, then obviously cash settled options are the way to go. But if we feel that we want the employees to share in the wealth, future wealth that is being created, and we want employees to really make money out of the appreciation that happens, then equity settled is the route. The second question is on whom to grant. I mean, we saw the practice in terms of what should be the coverage, what companies are doing, etc. So typically the thumb rule is companies are covering up to 10% of the employees. There also, the typical 80-20 rule would apply. So even if you were to cover less number of people, 20% of them would get 80% of the options. So that is a very common trend that we have seen. Typically at a senior management level, the options are, upward of 70-75%. The next big one is about the vesting conditions. We saw trends in terms of whether companies are going for time-based vesting or a performance-based vesting, and depending upon the goals that the company has. For example, if you are granting options with the aim of reaching or taking the company, say, to a second orbit, next orbit, and if you are wanting the employees to sort of play a role in that or be critical in that transition, then you may say that, okay, these options will vest only if we reach that level. It could be growth in top line, it could be growth in market share, or it could be growth in your profitability, or whatever, or you may have some operating goals as well, number of customers or penetration, or repeat customers, whatever may be the metrics that you have internally for your business. So if you are granting options with that performance in mind, then you may have conditions linked to that. The only challenge there is that you have to be very clear in terms of what those conditions are, and if you keep on changing the goalpost every year, it may not give a lot of confidence to the employees in terms of the consistency that we have in the way we are sort of managing this. I mean, the simplest way to do it, I mean, if the objective is retention, and if you feel that you have enough other sort of measures to ensure that once an employee is in the company, the performance can be controlled in some other way or monitored in some other way, you can just have vesting conditions based on time. So long as the employee is with the company, he will get his option, he will get his shares. We already talked about the quantum of grants, the 80-20. Our recommendations to companies have always been that whatever options, whatever pool you have, make sure that you grant more to fewer employees. So instead of spreading it too thin across large number, whatever pool you have, it's better to use it more aggressively with the people who are very critical. That also helps in value creation and strong motivation. On the instrument structure, the related question is also about dilution. What is the appetite? What pool should be kept aside? how should it change with the growth in the company and subsequent capital infusion, etc. I have not included that chart in the practices, but what we have seen is at a very early stage, companies would typically dilute up to 10 to 15%. I mean, that is a pool they would keep because you are already on a very low capital base. But as the capital infusion and you keep on adding capital later on, that percentage goes down on a steady state level. The pool, would be around 5 to 6%. So this is how it works. It's also a function of whether you are covering all employees or whether you are covering few employees. So it will also, what pool you have, it also depend on that. And also, what is the appetite given your investors and promoter holding considerations. You may decide that pool accordingly. I was told by the CXOGeni team that you had, there were some questions around how can the grants be made to non-employees or consultants, or the question was around what do you mean by, the new regulations say that, it allows non-employees to be granted so long as those persons are exclusively working for the company. So exclusive would mean, for example, typically it would cover somebody whom you have taken on a retainer basis, where he is not on the rolls, but he is like full-time working with you. So those categories of employees, or even if you have some consultants or advisors who don't want for other reasons to be on the rolls of the company, but otherwise they are full-time in the company, and they are sort of bound by other considerations that they cannot work anywhere else, etc. So long as that contractual arrangement is entered into, they should be eligible under the new regulations. There is also a question around when should we implement. We are a 5-people company. Is that the right time to do it, or we are already a 200-people company? Is it too late? Structurally there is no right time in the sense. In that sense, whenever you decide or whenever you are ready with other things, you can implement it at any time. So we have seen companies even thinking about ESOPs even before they are formed. So there is no specific time as such, though I think as I said, your design structure and the instrument structure would depend on what stage you are at and what is the time to liquidity that you have. Many times the impact ESOPs would have on your capital is ignored by companies. And as we know, ESOPs is a commitment by the company to give shares. So company, as far as company is concerned, it's an obligation. So it certainly has an impact on your cap table, even though those options have not been exercised. So what is a concept known as a diluted capital? So some of you who may already be using some kind of a cap table solution, this factor is already there. So they would ask you for the options granted, and it gets factored into your cap table while arriving at the holding of other shareholders, etc. So I think this is an important consideration whenever you are making a grant as to what impact it would have on the holding of all the other shareholders. The next challenge is on the plan documentation. This is again a very important one, and what we have seen is many companies have actually been doing very loose documentation, either in terms of granting, whenever they are appointing people, appointment letters have very loose wordings around ESOPs. Many times some values are mentioned, many times percentage of shareholding is mentioned, many times value is mentioned. As I said, what is a ESOP value is a very, it's very used very loosely. And this can be a challenge. Fortunately, in India, so far we have not had too much of litigation around ESOPs, but as we see and we hear every day, companies or employees making millions of dollars through ESOPs. If somebody were to be prevented or denied of those benefits, I mean, it can get into, I mean, the stakes are large enough to get into litigation. So documentation and strong legal documentation is in the interest of the company as well as the employee. So that we see as a big challenge. Acceptance of grant, as I said, some companies are saying that, you know, we don't want acceptance from the employee, but legally, if you were to ask anyone, an offer to be complete has to be accepted. Many large number of companies we have seen don't have contracts, ESOP contracts. So for them, ESOP grant letter, and so long as it is accepted by the employee, that is taken as a sort of a completion. But ESOP, many companies also put it in the employment contract, service contract. But ESOP being a different instrument, and it does not create an obligation in the sense that you're through a service contract, you are obligated to pay salary or other remuneration. But ESOP contract is completely discretionary for the company. So here there is no commitment to keep on granting to the employee, even though he may be with the company. So there is a strong case where you need to have a separate contract, ESOP contracts with the employees. The third challenge we see, as I said, is about how do we communicate value? And very clearly, as a person or as a company, as a shareholders, when we are granting options, I mean, all of us know that equity is the costliest form of financing. So if you are granting somebody equity, that's from a company point of view, it's a very costly source. And it is important that employees also understand it in the same sense. Many times employees feel that options are underwater, or their company is offering it to me at the market price. So what is in it for me? Obviously, they have not been communicated the value of the option. Value of the option is not, I mean, just to elaborate it more technically, there is an intrinsic value and there is a fair value. So even though options may be given at the current market price or fair market value, when you give an option, you are telling the employee that after 2 years, 3 years, 5 years, 7 years, no matter whatever is the value of that option or price of the share, you still pay today's price. So that is the value that employees need to be told, that even if I'm giving to you at a market value today, it has a value because that is all you will pay anytime during the next 7 years. Many times this is not communicated, and so, for example, we have seen appointment letters which say that you will be granted options worth 1 crore. Now, what does it mean? Does it mean that value of the shares that he gets will be worth 1 crore? Does it mean that the benefit that he will make out of those options is 1 crore? Does it mean that today that option value is 1 crore, or will it be after 3 years, 5 years, 7 years? I mean, those wordings are kept very loose, and I mean, sometimes these numbers really stick, and they are used in subsequent communications, etc. And in any case, putting down this in writing is not recommended at all, because nobody can assure that employees would make that kind of money. So understanding what is value, communicating it properly so that the employee looks at it in the right sense is very critical. And this is something which is, especially where this communication or interaction with the employees, etc., happens with, amongst it's done by, say, non-finance people or not non-tax people, etc. I mean, many times it can get, confusing. So this is again a very big challenge, and I think what we have been recommending companies is not to mention anything about value in the communication, in the documentation that you do. For example, the grant letter or the whatever offer letters you give. You may at best mention number of options. Don't even mention percentage of equity, because that is a dynamic number. Percentage 2% today could mean 0.2% after you do some capital infusion, whereas the employee will always keep on feeling that he is owning 2% of the company. So it's very risky and not desirable at all to put any value in the documentation and also not any percentage. You may at best mention number of options that you may grant him if you are sure at the time of giving those offers as to you'll be able to do that. And in any case, um, one more problem in the documentation is if the HR manager or if even a CEO for that matter, if he's signing a letter which says that I'll give you say 1 lakh options, many times it is not mentioned that this is subject to the board approval. Even if it is a CEO, legally he is not authorized to sign a grant. The grants are always legally required to be signed by the board. The safer and the most ideal way to communicate it is we'll grant you 1 lakh options subject to board approval or subject to shareholder approval, which is the way which is done better. The fourth challenge is about how do unlisted companies manage the exercise process, and I think the bigger one there is how do you deal with separating employees. So you have a situation where an employee has vested options and he's wanting to leave, and he's asking you, I want to get shares, so I am willing to pay money, but you give me shares. So that is one scenario where employee is wanting shares by paying the price, and whether you should accept it or not accept it. The second situation is employees are saying that I am leaving with vested options, but your shares are not listed, there is no liquidity, etc. So there is no point in me buying those shares. But you take back these options and you pay me whatever is the difference or whatever is the appreciation, you settle it in cash. So in both these situations, this is an employee sort of expectation or employee's requirement or his demand. Looking at it the other way around, where if an employee says that I'm willing to pay for the price, give me the shares, and allow me to walk away, how should the company respond to it, or what care should the company take to ensure that its future transactions are not sort of impacted. So one risk there is if you allow an employee to walk away with the shares, once he becomes a shareholder, he is obviously entitled to all the shareholder rights, which is not only financial rights like a dividend, etc., or bonus, etc., but also right to receive information and right to you're obligated to share your financial information, annual report, balance sheet, etc., with this employee. Similarly, many companies have also not been very careful about allowing transfer of shares by these employees. Though it is possible to have specific contracts wherein you say that even if you have shares, you cannot sell it to anybody unless you take right of first refusal from the company or from the promoters. Many companies have not been following that, and it can create a situation where you would have people whom you don't know and they can come on your cap table. So impact on the cap table of having such unknown people is quite risky, especially if you go in for some corporate action. For example, if you go in for some acquisition where or the sale where the buyer wants to own 100% of the equity, and you firstly are not able to trace this employee where he has gone, and even if you are able to trace, he may or may not be very cooperative in terms of selling the shares to the buyer. So there are some situations where it's not advisable allowing employees to walk away with the shares. Though, as we have seen, many companies are allowing that. I think they will. And we have seen companies which are struggling, and this also has led to the deal not getting through because the buyer is not willing to have anybody else on the cap table. So that's a risk we have to really weigh, and I think the best practice there would be, even though you may want to allow employees to hold shares while they are in employment, you can compel them to sell it back either to the promoters or to the company whenever they are leaving. The best situation would always be that you don't allow exercise till there is a liquidity event. And it's also good for the employees because they don't carry any risk. They don't have to invest any money, and when there is no liquid market for those shares. So, but it also depends on what advice the employee has been getting from his advisors. Overseas employees is another big challenge. I mean, whether you allow them to buy shares, and here the challenges are in terms of his remitting money here, his opening of demat, and all those other PAN and all that. And by overseas employees I mean foreign nationals, and it is quite a pain for having overseas employees on your cap table and giving them shares. So companies should really be careful to know as to what are the processes to be followed and what are the regulations around this. So mostly the FEMA regulations which are in place here. Of late, the kind of money or the kind of appreciation unlisted companies have been having in their valuations. Many times the price which the employee pay is a small fraction, but the tax is a very high component of that. And many times employees don't have funds to pay for those taxes. In the listed space, there are many lenders who lend money for these exercise of options, but this funding is not available when the shares are unlisted. So that is again a big challenge, and employees have to sort of arrange for the funding on their own. Coming to the last challenge in terms of how does one make ESOPs work? As we have seen, communication is a big factor which goes in making ESOP successful. And communication is not only in terms of what kind of documentation you do and at the time of grant. Many companies make it like a big event and a town hall and those kind of things where it is made out as like a big event where we are offering you equity, which is good to make an impact and good to make the employee feel happy and recognized. But it's also important that since ESOPs have a life of at least 5 to 7 years, it is also important as to how the company is doing the ongoing communication, especially when there are 2-3 situations where employee may feel disconnected or disengaged. One is where companies which are raising money regularly, I mean, employee gets to read it only in the press that we are a unicorn or we are valued so much and our valuation has gone up 5 times in the last 2 years and all of that. But he doesn't know as to what does it mean to him. Or he doesn't know whether, his value also has gone up by that amount or etc. Or what is the exact benefit that he's going to make out of it. And it is for the companies here to sort of share not only this news about whatever comes in the press in terms of what it means for the ESOP holders, but also in terms of many employees feel, I mean, they don't make a distinction between a vested option and unvested option. So if you just granted somebody, say 6 months ago, and it has a 3 or 4 year vesting, whatever is the valuation today, which is published in the press, has no direct relevance for that employee. I mean, he should not start calculating counting the money, because in any case he cannot even exercise those shares. So this kind of communication in terms of to tell this to the employees is very important. I mean, it's not only good enough to communicate the positive side of it, but also we need to tell him what is the factual situation. There are also situations where companies are not doing well, and in that case also a very strong communication with the employees as to why the last quarter has not been good or last 1 year has not been good, and how we can make it up in the next 1 or 2 years, etc. is something which is important, because ESOPs is a long-term instrument, and even if a company has a bad 1 year or 6-7 quarters, it is companies have time, or the ESOP holders have time within which the company can make good that loss, and ESOPs would still be worth it. But all of this has to be communicated on an ongoing basis with the employees. The next big gap is in terms of transparency, especially unlisted companies. Companies need to be transparent in terms of what they are communicating, sharing of financial results, sharing of some operating results, in terms of, or even if there is some corporate action or some major development which is impacting the options, or that has to be shared transparently with the employees, which is very, very critical. The third big point in terms of making ESOPs work is how are we providing liquidity. As I said, time to IPO has already more, close to doubled, and employees cannot wait for that long. So obviously companies have to provide liquidity, and how it will be provided, and what is the possibility of employees encashing some of these gains is something which firstly has to be in the plan itself, some mechanism, and secondly, it has to be implemented. It has to be executed to make sure that employees continue to have the excitement and the interest, and they actually see that money can be made from ESOP. So it also creates as a good sort of confidence building measure for employees to know that if they continue to accept grants, it is going to be good for them. Also, last factor where we see is critical for making ESOPs work is, as I said, grant more to fewer people, but grant it regularly. So you should grant more because ESOPs should be a deterrent where the value of the options or the unvested options is so large that it acts as a deterrent for him to leave. So it should be significant. It should also be significant so that it can drive his behavior or his thinking or his performance. So in that sense also it should be significant. But it is also important that we grant regularly. It should not happen that we grant today and then next 3-4 years we don't do anything and it's all forgotten. So typically, as we also saw that more than 50% of the companies grant on an annual basis. So it should be seen as a regular feature, and this is something which employees would feel as a part of the regular compensation or the practice that the companies have, and it should not be like to the whims of the management. So this is where we felt the top 5 challenges, and some of the key aspects within those challenges. I think we'll have another 8-10 minutes for the question answer. So happy to answer any questions.
Yes, Harshu. So thank you for the session. So we have a few questions on the chat. Yeah. The first one is how to democratize the ESOP policy with exceptions for tech.
Yeah, so democratizing ESOP policy. So exactly, I'm not able to understand what you mean by democratizing. So if you are saying that you want to give to everyone, if you mean democratizing by that sense, it's a function of whether how much appetite you have. As I said, there's no point in covering too many employees and giving them very few options, because in terms of value it will not mean much. And more importantly, what we have seen is companies who go big bang in terms of covering every employee, etc., soon realize that they don't have enough equity. So they may make 1 or 2 grants and then they feel that we don't have enough shares, so let's come down to 10-15% of the employees. So especially the HR professionals would understand that once you give a benefit, it's very difficult to withdraw it. So we would recommend that companies go slow in terms of starting. If you feel that it's working and it's achieving the objectives, maybe you can increase the span later on, but it would be good to sort of go slow on the coverage initially.
Yeah. The other one I think you've already answered. What is the interpretation of employee must be exclusively working for the corresponding company?
Yeah, I have addressed that.
Yeah. Then the other one is, in a listed company, are there avenues to grant ESOPs to consultants?
Yeah, so I think the criteria would be same here, whether they are working exclusively for you. If they are like a retainer where they come 2-3 days and spend 2-3 days, or it's need-based, where they are not dedicating their full time to you, they will not be eligible.
Sure. Then the next one we have is from Satyam Arora. Do phantom stocks have the same legal validity as ESOPs? In case of a dispute between employees and the founders or investors in an unlisted company?
Phantom stocks is actually like any other incentive. So it is not equity or anything. So it would have the same protection for the employee as he would have with respect to, say, his employment contract. So if a phantom stock is committing that you have been given, say, X number of options, phantom stocks, and this is how the benefit would be calculated, and this is how you'll be paid, etc., frequency and valuation methodology, etc., then it has the same protection as your employment contract would have. Not many companies have a legal contract for phantom because they club it normally with any other cash compensation. But I mean, since there is no equity, there is not much importance given to a separate legal contract for phantom. But I think in terms of the protection, it will be same as your employment contract.
Yeah, thank you. The next one is senior candidates ask for value of grant, especially in unlisted company, where number of options are not enough info.
Yeah, this is where I think, candidates also, as I said, value is a very subjective term and people interpret it, different people interpret it differently. I think there is some education required here with the candidates also. Many times what they are saying is, when they are asking for a value, they want to compare with whatever they are foregoing with their earlier jobs, right? And there also it's a calculated value. There is no unless somebody is really well informed and he is really asking some relevant questions, or he has relevant data, it will be good to know from him as to how is he calculating that value. For example, if he says that by joining with your company, I'm going to forego that option, forego that value, then you should ask him as to how have you calculated that value. And then you could match it on the basis of the way he has calculated it. For example, if he really has the market value of the options, and if he really has what price he's going to pay, and that is how I've calculated the value, then you can also sort of give a matching offer in that sense. But if he's just multiplying the number of shares options that he has with the the reported or whatever the valuation is there in the market, that may not be correct, because firstly, those options may not be vested options. So this is not something that he's getting immediately. And secondly, he's not deducting, whatever price he has to pay to get those options. So I think it will be good to drill down further and find out exactly what does he mean by value and how has he calculated, so that you can give a counter offer. But in any case, you may want to do this as an oral communication, but we would recommend not to do anything on paper.
Yeah. The next one we have is, excuse me, can we please get the, sorry. So Vinay is asking for recording of the session. Yes, Vinay, we will be recording this session and will be available on the website in a week's time.
I think somebody has asked for a email phone number. I think one of my colleagues can pass it on to him. GC some message.
Definitely. So in case you guys would want to connect with Harshu, please feel free to reach out to us and we'll help coordinate with the team, with Harshu's team. All right. Thank you so much, Harshu, for this wonderful session and a lot of things to learn on the ESOP side. And we look forward to having some more sessions from you in a sequence. And I would sincerely thank the audience to be here and being part of the session today. Thank you,
so
everyone.
much. Pleasure,
Have a great
pleasure.
weekend.
Yeah,
thank you, Harshu.
Thank you.